Welcome to Quick Invest Brief. You're seeing the headlines everywhere. AI is changing everything. It's writing code, automating jobs, and fundamentally shifting the global economy. Everyone is chasing the same few AI software stocks: NVIDIA, Google, Microsoft. But they are missing the simpler, safer, and arguably more profitable thesis. The big question for smart investors isn't which AI software will win. The answer is far simpler and far more profitable. You see, AI doesn't just run on code, it runs on physical infrastructure. It requires staggering amounts of power, data, bandwidth, and hard-to-find resources. The real money isn't always in the software. It's in the picks and shovels that everyone needs to dig the AI gold. Think of it like the California gold rush. The real fortunes were made by those selling the shovels, not the ones digging the dirt. Today, we are building the AI income engine. We're breaking down the 5 essential investment plays guaranteed to thrive, regardless of which software company comes out on top. Let's dive in. The first crucial component is the power utility engine. Forget the consumer-facing AI models for a moment and zoom out to the sheer physics of the problem. Training a single large AI model can consume the power equivalent of 5 average American homes for an entire year. The AI boom is causing an unprecedented, exponential surge in electricity demand, primarily driven by massive, always-on data centers. Traditional power grids are simply not equipped for this level of sudden, massive, sustained growth. They need billions in immediate upgrades just to cope. You need to invest in the companies that generate and transmit clean, reliable power at massive scale. Look beyond just solar panels or wind farms. Focus specifically on the utilities and power infrastructure companies that are building the next generation of resilient grids. Look for utilities with heavy exposure to servicing the data center clusters and those natural gas providers positioned to handle base load power for these giant new centers. They have massive pricing power because the demand is non-negotiable and essential to the AI economy. Without reliable, vast amounts of power, the entire AI industry stops. These companies are selling the most fundamental commodity in the new digital age. Research utility infrastructure ETFs that focus on grid modernization and energy transition assets. Prioritize companies with announced contracts or partnerships with major tech developers. The second essential component is the digital landlord thesis: data center real estate. If AI is the tenant, the data center is the hypersecure, specialized, million-dollar apartment. These are purpose-built, high-security warehouses designed to hold and cool the thousands of servers and processing units required to run AI models 24/7. The physical space required for these AI servers is immense, and the demand for new data center capacity is outstripping global supply. You want to own the landlords, not the renters. Look for data center REITs, real estate investment trusts. These companies own the buildings and lease the space, power, and high-tech cooling systems directly to the tech giants like Microsoft, Google, and Amazon. This is the ultimate picks and shovels real estate play. You don't bet on which software is better. You bet on the physical building every major tech company must rent to run their operations. Their contracts are long-term, often 10-15 years. Their rents are rising to cover energy costs, and the demand is non-negotiable. They are collecting the rent on the future. Allocate a portion of your portfolio to diversified data center REITs to become a digital landlord and benefit from long-term, inflation-linked rental contracts. The third component moves outside the electric grid and focuses on the scarcity trade, essential resources. Building AI chips requires high-end materials, but the real pinch point, the essential bottleneck, is the power grid itself. You need to own the resources that enable this massive global electrification. Specifically, look at copper and certain rare earth minerals used in batteries, magnetic storage, and advanced computing components. Copper is absolutely essential for every wire, every grid upgrade, and every transformer needed to feed these hungry data centers. As demand skyrockets due to both the AI boom and the broader green energy transition, the supply side is struggling massively to keep pace. This is a pure inflation-proof scarcity trade. You are owning the physical, tangible components of the AI revolution that cannot be easily replicated or printed by a central bank. This provides a hard asset hedge against digital volatility. Look for low-cost ETFs that track industrial metals, particularly those with heavy, focused exposure to global copper mining and production assets. The fourth component addresses the inevitable vulnerability and risk, the defensive security layer, cybersecurity. As AI tools automate everything from customer service to financial analysis, they introduce entirely new, complex attack vectors and create massive consolidation of risk. If a single AI model is handling millions of customer records, the security of that model and the network it runs on is absolutely non-negotiable. Invest in the companies that secure the network, the data, and the AI model itself. Focus on platforms that offer comprehensive zero-trust security architecture, especially those using AI internally to detect new, rapidly evolving threats. These services become mandatory operating expenditures, OPEX, for every single enterprise on the planet. Cybersecurity is arguably recession-resistant, and demand is non-cyclical. When corporate budgets get tight, companies may cut marketing or hearing, but they never cut the budget protecting their core intellectual property and customer data. It's an indispensable insurance policy. Target a concentrated, diversified basket of leading cybersecurity stocks or a dedicated ETF focused on the enterprise defense space. The final component is the infrastructure bridge strategy, fiber and telecom. AI data isn't just processed in the cloud. It has to move instantaneously, often across thousands of miles, between the data center and the end user. Lag is absolute death in the automated economy, especially for things like automated driving or remote surgery. On the highways, we are talking about companies that lay and maintain the fiber optic cables, manage the physical cell towers, and operate the essential telecom backbone connecting global systems. These are essential utility-like assets that provide reliable, long-term, annuity-style cash flows. Whether you're using AI on your phone, in a corporate cloud, or in a medical device, the data must travel across this physical infrastructure. You are collecting the toll from every single data transfer. The regulatory barriers to entry in this space are incredibly high, which protects your investment from competition. Invest in specialized infrastructure REITs, or specialized funds, focused on long-haul fiber and cell tower management. The AI income engine is built on these 5 foundation points: power, digital real estate, scarce resources, cybersecurity, and the infrastructure bridge. By focusing your investment on the physical and defensive infrastructure, the picks and shovels, you're investing in the parts of the AI economy that cannot be easily disrupted, replaced, or printed into existence. This is the smart, low-volatility way to profit from the largest technological shift of our time. If you found this insight helpful, hit that like button, and make sure you're subscribed to Quick Invest Brief for more powerful insights. Briefly told.